Good day, everyone. Today, we will be discussing an important and complex topic, transfer pricing for joint ventures. So this is module 23. Transfer pricing in joint ventures is what we will be looking at today. Joint ventures are commonly used by multinational enterprises to share resources, expertise, and risk in pursuit of specific objectives, such as entering new markets or developing new products. However, joint ventures often involve various intercompany transactions that must comply with transfer pricing regulations. These regulations require that transactions between related entities reflect the arm's length principle, meaning they must be priced as if they were conducted between independent parties. So in this session, we will explore pricing strategies for joint ventures, how to ensure compliance and documentation, and then we'll also take some real-world case studies illustrating practical applications of transfer pricing in JVs. Let's start by diving into the core pricing strategy. So pricing strategies for joint venture is what we will start with. Now, joint ventures often lead to a range of intercompany transactions, such as the provision of goods and services between the JV and its parent companies, intangible asset transfers, such as licensing, intellectual property, or technology, then financing arrangements, including loans, guarantees, and other financial support. So these transactions must be carefully priced to ensure they comply with transfer pricing regulations and reflect the true economic reality of the transaction. So now let's look at key consideration, nature of the joint venture. Now there are two main types of JVs to consider. We have the operational joint venture. These are partnerships where resources, expertise, and operations are shared for a common business purpose. Each party typically contributes know-how, technology, or products and shares in the outcomes. Each party typically contributes know-how, technology, or product and shares in the outcomes. Now, equity joint ventures. Partners contribute capital and receive profit and losses in proportion to their equity stake. The focus here is more on investment returns, with operational decisions influenced by the equity structure. Now let's look at type of transactions under JV. The following are common intercompany transactions within a JV. Provision of goods and services. These include the transfer of products, materials, or services. Transfer pricing needs to account for production, logistics, and distribution costs, reflecting market condition. Intangible asset transfers also, licensing intellectual property, technology, or trademarks to the JV. Pricing should be based on the expected economic benefits of the intangibles. Now, on financing arrangements, loans, guarantees, or other financial support provided by the parent companies, transfer pricing must ensure that interest rates, repayment terms, and financial guarantees reflect arm's length principles. Now, let's look at pricing strategies. The appropriate pricing method depends on the nature of the transactions performed. The appropriate pricing method depends on the nature of the transactions, functions performed, and risk assumed by each party in the joint venture. Below are some common transfer pricing methods. We have the comparable uncontrolled price method. This method compares the prices charged in similar transactions between independent parties. It is suitable when comparable transactions exist, such as for the sale of standard products or services. The cost plus method, a markup is added to the costs incurred in providing goods or services to reflect an arm's length profit. This method is commonly applied in contract manufacturing or the supply of raw materials. Now, with transactional net margin method, which examines the net profit margin relative to an appropriate base such as cost or sales. TNMM method is ideal for more complex services or when significant risks are assumed by one party. Now, with the profit split method, the combined profits from the JV's activities are allocated on each party's relative contributions. So this method is appropriate when both parties contribute valuable intangibles or assume significant risk. Now, let us look at the best practices for pricing strategies. Now, functional analysis. Conduct a detailed analysis of the functions performed, assets used, and risk assumed, that is the FAR analysis, by each party in the joint venture. This will guide you in selecting the appropriate pricing method. Now, another is, use reliable external data to benchmark transactions. We're talking about benchmarking now, ensuring pricing is consistent with market rates and reflects arm's length principle. Consistent application. Apply the choosing pricing methods consistently across all JV transactions. This will help avoid discrepancies and ensure compliance with tax regulations across jurisdictions. So now let's look at compliance and documentation for joint venture. Now, to ensure compliance with transfer pricing regulations, joint ventures require meticulous documentation. Proper documentation not only supports the pricing of intercompany transactions, but also prepares the JV for potential audits by tax authorities. Now, let's look at key compliance requirements. Detailed agreement. You can see we're starting with number one, detailed agreement. Now, under this detailed agreement, JV agreement, this should clearly outline the roles, responsibilities, and contributions of each parent company. The agreement should define the scope of activities, decision-making processes, and profit-sharing mechanism. Now, with respect to intercompany agreement, this should specify the terms of transactions between the JV and its parent companies, including pricing, payment terms, and the nature of goods or services provided. 2, on functional and economic analysis. Functional analysis, you need to conduct a functional analysis, FAR analysis, to evaluate each party's contribution to the JV's operation. Identify the level of responsibility, resources employed, and risk assumed by each parent company. Economic analysis, you assess the economic conditions, industry practices, and market trends affecting JV's transactions. Ensure that prices reflect the economic reality of the transactions. Now, transfer pricing documentation. This is also very important. The master file provides a high-level overview of the global businesses or of the global business, including the JV activities, its structure, and its relationship with parent companies. Now, the local file contains specific details of the JV's intercompany transaction within each jurisdictions. These include functional analysis and benchmarking studies. With respect to supporting documents, includes invoices, contracts, financial statements, and other documents that support the transfer pricing policies. Now, with respect to regular reviews and audits, like I said, internal reviews is very important. You need to, do a transfer pricing health check, to do an internal, regularly review your JV transactions and transfer pricing policies to ensure compliance with changing regulation and business activities as applicable. Now, with respect to audit preparedness, once you maintain comprehensive up-to-date documentation to prepare for potential audit by tax authorities, when you maintain comprehensive, up-to-date documentation to prepare for potential tax audit authorities. This includes functional analysis, transfer pricing methodology, and financial data. Once all these are put together in a comprehensive document, you are proactively preparing for tax audit. Now let's look at okay, before we go to case study, let's look at the best practices for compliance and documentation. So proactive communication: maintain open line of communication with tax authorities to clarify expectation for JV transaction and demonstrate a commitment to compliance. Yes, these are best practices for compliance and documentation. You need to be proactive with your communication, maintain open lines of communication with tax authorities to clarify expectation for JV transactions and demonstrate a commitment to compliance. Now, consistent documentation also ensure that documentation is consistent across all jurisdictions and accurately reflect the JV's economic activities. Then continuous monitoring: regularly monitor regular changes and adjust transfer pricing policies as needed to remain compliant with evolving tax laws. So let's look at a case study. Now we're going to be looking at some practical examples to illustrate the application of transfer pricing principles in joint venture. Now let's look at case study 1, operational joint venture. Case study on transfer pricing. We have the operational JV for manufacturing. Now ABC Manufacturing Limited, a multinational company, forms a joint venture with DEF Industries to manufacture and distribute automotive parts. Now the JV operates in Germany and source raw materials from both parent company. Now implementation: how are they going to implement this operational JV to ensure compliance? Now the pricing strategy first. ABC Limited uses the cost plus method, applying a 15% markup to the raw material supplied to the JV. This markup was determined through benchmarking independent transactions. Now, on functional analysis, the analysis identified each party's contribution, such as technology provision, management oversight, and supply of raw materials. On documentation, comprehensive joint venture agreements, intercompany agreement, and benchmarking studies were prepared and used to support the analysis. Now, with respect to the outcome, let's look at compliance. The detailed pricing strategy and documentation ensure compliance with German transfer pricing regulations, and the JV benefits from both parent companies' expertise, leading to improved manufacturing processes and cost savings. So that is that for case study 1. For case study 2, equity JV for technology development. Now let's look at GH High Tech Limited, a global technology company, forms an equity JV with JKL Innovations to develop new software. Both companies contribute capital and expertise to the JV, which is based in India. Now, with this implementation, the pricing strategy that they use, GH High Tech Limited uses the profit split method to allocate profits based on each parent company's relative contribution to the software development. Secondly, research and development costs are shared, which is cost allocation, with detailed record kept of the cost incurred and expected benefits for each party. Now, documentation: a comprehensive JV agreement, functional and economic analysis, and benchmarking studies were prepared. I hope we are taking attention of all the documentation that is required. You can see here we're talking about JV agreement, functional and economic analysis, and benchmarking studies. Now, equitable allocation: the profit split method ensures profits are allocated fairly based on contribution. On regulatory compliance, detailed documentation ensure compliance with Indian transfer pricing regulations, reducing the risk of tax dispute with the Indian tax authority. So now we'll look at the last case study. Now we'll be looking at LMN Pharmaceutical Multinational Enterprise. A multinational pharmaceutical company licenses its patented drug formula to a JV formed with XYZ Biotech to commercialize the drug in Europe. Now, on this implementation, LMN Pharmaceutical used the relief from royalty method, calculating the present value of future royalty payments saved by the JV by owning the patent. Now, economic analysis: future revenue generated by the drug is projected and an appropriate discount rate is applied to determine the present value of the royalty savings. Documentation: a comprehensive documentation includes the license agreement, functional and economic analysis, and benchmarking studies. Now, with respect to outcome, there was accurate valuation. The relief from royalty method provides an accurate reflection of the patent economic benefit. With respect to audit preparedness too, the detailed documentation prepares the JV for potential audit by European tax authorities. So, just to conclude, in conclusion, transfer pricing in joint ventures is a complex but essential process for ensuring compliance with tax regulations. To manage this effectively, companies must conduct thorough functional analysis, choose the appropriate pricing strategies such as cost plus method, TNMM method, or the profit split method. Now, they should also maintain comprehensive documentation to support their transfer pricing policies. And by adhering to these best practices, companies can effectively manage the transfer pricing of joint ventures, minimizing tax risks and ensuring compliance across jurisdictions. Thank you for your attention.